Right now, something very important is happening in the gold and silver markets, and most people are completely missing it. Prices are moving, volatility is rising, but smart money is not chasing the market. Instead, they are waiting, watching, and preparing for the next big move. Because in markets like gold and silver, the real profits are not made in chaos. They are made just before the explosion begins. Welcome to Gold Silver Scope, where we break down complex market moves into simple and clear insights so you can understand what's really going on behind the scenes. At this moment, gold and silver are not in a clean trending phase. In fact, experienced traders have already stepped aside after catching the earlier move. They exited before the recent sharp drop, and now the market is in what we call a cooling phase. This is extremely important to understand. Markets do not move in a straight line. After a strong rally or a sharp drop, they need time to settle, to rebalance, and to prepare for the next direction. The key concept here is volatility. When volatility expands, prices move fast and aggressively. But before that expansion happens, there is always a phase of compression, where the market becomes quiet, slow, and tight. This is where the biggest opportunities are formed. Smart traders don't chase the move after it happens. They wait for this compression phase, because that is where risk is low and potential reward is high. Right now, gold is moving inside a defined range. On the upside, the market has already shown weakness after forming a bearish signal known as a shooting star. This pattern usually indicates that buyers are losing control. But immediately after that, the market formed a hammer pattern, which is the opposite. It shows that sellers also failed to push prices lower. So what does this mean? It means the market is confused. Neither buyers nor sellers are in full control. This creates what we call a range-bound market. Gold is now moving between key levels, roughly between the upper zone around 5.6 and the lower zone around 4.4. Inside this range, price can move up and down without creating a strong trend. And this is exactly the type of environment where many traders lose money, because they expect big moves, but the market just keeps moving sideways. This sideways movement is not random. It is actually the market preparing itself. Think of it like a spring being compressed. The tighter the compression, the stronger the eventual move. But here's the important part. No one knows exactly when the breakout will happen or in which direction. That's why discipline and patience are critical. Right now, the expectation is that gold will continue to move inside this range for some time. It may bounce from the lower level and go back up, or it may drop again after reaching the upper boundary. But until the market clearly breaks out of this range, there is no strong directional trade. However, the bigger picture tells a very different story. Even though the short term looks slow and uncertain, the long-term trend for gold is still very strong. The previous breakout that started in late 2023 and early 2024 was not random. It was built on a strong foundation, a large continuation pattern that had been forming for a long time. Before that breakout, gold went through a long period of volatility compression. Prices were moving in a wide, unstable structure, shaking out weak hands. But slowly, that volatility started to reduce. Instead of making lower lows, the market started stabilizing. This was the first sign that something big was coming. And then, on a smaller time frame, another compression formed. Even tighter, even more controlled. This was the final stage before the breakout. When that level finally broke, gold didn't just move a little, it exploded. It delivered a massive move, far beyond what most people expected. This is the power of understanding volatility. It's not about predicting the future. It's about recognizing the conditions that lead to big moves. And right now, we are again entering a phase where those conditions are slowly building. But patience is key, because jumping in too early, before the compression is complete, can lead to losses. The market needs to calm down first. The volatility needs to drop. the candles need to become smaller. Only then does the next high-probability setup begin to form. So at this stage, the smart approach is not aggressive trading. It is observation. It is preparation. It is waiting for the market to show its hand. And once it does, that's when the real opportunity begins. To truly understand where gold is heading next, you need to step back and look at the bigger structure that built the entire move. Because what we are seeing today is not random. It is the result of a long-term pattern that has been developing for years. Before gold made its powerful breakout, it formed a very important structure known as a broadening pattern. This is a type of formation where price swings become wider over time. You see higher highs, but also lower lows. It looks unstable, almost chaotic. But in reality, this structure is doing something very specific. It is removing weak participants from the market. During this phase, many traders get shaken out. Some buy at the top and panic sell at the bottom. Others lose confidence because the market feels unpredictable. But this is exactly what strong markets do before a major move. They create discomfort. They test patience. In gold's case, there was a clear upper resistance level around the 2000 zone. Price tested this level multiple times but failed to break it cleanly. At the same time, the lows were gradually expanding downward. This created a wide, stretching pattern, a sign that volatility was high, but direction was not yet confirmed. Then something changed. Instead of continuing to make deeper lows, gold started to hold higher levels. The selling pressure was no longer strong enough to push the market down. This was the first signal that volatility was beginning to compress. The market was no longer expanding. It was starting to tighten. This tightening is extremely important, because when volatility contracts after a broad and unstable phase, it often leads to a powerful breakout. And that's exactly what happened. On a smaller time frame, this compression became even clearer. Price started moving in a tighter and tighter range, forming what can be described as a funnel. Each move became smaller. Each reaction became weaker. The market was losing its randomness and preparing for direction. This is where experienced traders look for entry. Not when the market is already moving fast, but when it is quiet and controlled. Because in that moment, risk is low. You can define your stop clearly. And if the breakout happens, the reward can be massive. When gold finally broke above that key resistance, it triggered a strong continuation move. The breakout was not just technical. It was fueled by all the pressure that had built up during the compression phase. That's why the move was so powerful. Gold didn't just reach the expected target, it went far beyond it. The initial projections suggested a move toward 3,000, but the market extended all the way to around 3,500. This shows how strong continuation patterns can exceed expectations when momentum is fully unleashed. Along the way, there were multiple smaller compressions. Each time the market paused, reduced volatility, and then continued higher. These were opportunities for traders to re-enter and ride the trend again. But eventually, every trend reaches a point of exhaustion. In gold's case, this happened during a sharp and aggressive move higher, what we call a blow-off phase. The price accelerated quickly, volume increased, and candles became larger. This is usually a sign that the move is reaching its peak. After that, the market experienced what can be described as a slapback, a sudden pullback that catches late buyers off guard. This is a natural part of market cycles. After a strong rally, the market needs to correct. Now, if you look at the current structure, you can see that volatility is still relatively high. The candles are large, and the market is reacting strongly in both directions. This tells us that the market has not yet fully stabilized. However, there is an important shift happening. The candles are slowly becoming smaller. The volatility is starting to reduce. This is the early stage of a new compression phase. At the same time, key levels have already been broken. The market has moved below important mid-range support levels, which places it in the lower half of the current range. This means that, in the short term, gold is not in a strong position. But this does not change the bigger picture. From a macro perspective, gold remains bullish. The overall trend is still intact. What we are seeing now is not a reversal of the long-term trend. It is a pause, a reset, a preparation phase for the next move. And this is where many people make mistakes. They see short-term weakness and assume the trend is over. But in reality, strong markets often move sideways before continuing higher. The same logic applies to silver, but with even more potential. Silver has already reached an important interim target and then experienced a strong pullback. But once this current phase of volatility settles, the long-term outlook suggests a much bigger move ahead. There is a strong expectation that silver could eventually move toward the 333 level and even beyond. But just like gold, it needs time. It needs compression. It needs the market to calm down before the next expansion begins. So right now, the focus should not be on chasing prices. It should be on understanding structure, recognizing volatility, and waiting for the right setup. Because the next big move is not built in chaos, it is built in silence. When you step back and connect all the pieces together, a very clear picture starts to form. Gold and silver are not finished. In fact, they are likely preparing for the next major phase of their long-term trend. But the current environment is not about aggressive action. It is about patience, discipline, and smart positioning. Right now, gold is sitting in a wide range. It has already shown both bullish and bearish signals, which tells us that the market is undecided in the short term. This kind of behavior is very common after a strong trend. The market needs to find a new balance, a new fair value, before it can continue. The key level to watch on the downside remains around the lower boundary near 4.4. If the market breaks below this level, it could signal a deeper correction. But as long as gold stays within the range, the overall structure remains a continuation pattern. On the upside, the market needs to regain strength and break above the upper boundary to confirm the next bullish move. Until then, price action will likely remain slow, choppy, and unpredictable. This is not the kind of market where emotional trading works. This is where strategy matters. At the same time, the macro environment still supports higher prices in the long run. The global financial system is under pressure, debt levels are high, and currencies continue to lose purchasing power. These are the conditions where gold and silver historically perform well. However, it's important to stay realistic. Markets do not move in straight lines. Even in strong bull markets, there are corrections, consolidations, and periods of uncertainty. These phases are not a sign of weakness. They are a necessary part of the trend. Silver, in particular, stands out with significant upside potential. After reaching its recent target and pulling back, it is now entering a similar phase of volatility adjustment. But once this phase is complete, the next move could be very powerful. The long-term projection toward 333 is not based on hype. It is based on structure, volatility cycles, and historical behavior. But again, timing is everything. Entering too early can be just as risky as entering too late. Beyond markets, there is also a bigger theme that cannot be ignored: the global economic shift. For years, asset prices have been driven higher by easy money, excessive debt, and financial expansion. But this system is starting to show cracks. As conditions tighten, we may see a reset in asset values, changes in lending behavior, and pressure on living standards. This is why wealth protection becomes just as important as wealth creation. In such an environment, having flexibility is key. Different regions, different systems, and different opportunities will offer different advantages. The world may appear connected, but there are still differences that matter. And those differences can create opportunities for those who are prepared. The main idea is simple. Build wealth during strong trends, protect it during uncertainty, and always stay adaptable. Because the future will not be the same as the past. And this brings us back to gold and silver. They are not just trading instruments. They are also a form of protection in uncertain times. That's why understanding their behavior is so important. Not just for profit, but for long-term security. If you want to stay ahead in this space, if you want clear, simple, and powerful insights on gold and silver, then make sure you stay connected with Gold Silver Scope. Because here, we don't follow the noise. We focus on what actually matters.